Jake buys a rental property. Marcus puts the exact same amount of money into index funds. Both are convinced they made the smarter call. They're both mistaken because one of them forgot to count the hours and the other forgot to count the zeros. When you actually run the numbers across 20 years, the gap between what they expected and what they got will make your stomach drop. To keep this genuinely fair, Jake and Marcus both have $50,000 saved. Both earn $55,000 a year. Same age, same city, same financial starting point. The only variable is what each of them does with that $50,000. Jake uses his as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest, bringing his monthly payment to roughly $1,330. He finds a tenant willing to pay $1,800 per month. On paper, that's $470 in monthly profit before a single additional dollar goes out the door. Jake feels like a genius. Marcus takes that same $50,000 and deposits it into a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic monthly contribution of $300 and doesn't think about it again. When his co-workers ask what he's investing in, he says index funds. They nod politely and change the subject. Nobody is impressed. On day one, Jake has a physical property, a paying tenant, and a story worth telling at dinner parties. Marcus has a brokerage account and a confirmation email. In terms of how it feels, it isn't even close. But feelings and mathematics are two entirely different things. For the first few years, Jake is living what looks like the landlord dream. Rent arrives in his account on the first of every month. He drives past his property on the way to work and thinks, I own that. He's writing off mortgage interest and depreciation on his taxes, trimming a couple of $1,000s off his annual tax bill. Equity is building with every mortgage payment. Comparable homes in the neighborhood are ticking upward in value. Every aspect of this investment feels tangible, real, and intelligent. Marcus, meanwhile, logs into his brokerage account once a quarter. He watches the number rise slightly, dip slightly, then climb a bit further. After year one, his $50,000 has grown to roughly $55,000. By year two, perhaps $61,000. Nothing feels like it's happening. There's no key in his pocket, no tenant texting him about a broken appliance, no asset he can gesture toward from his car window, just a number on a screen. Jake's friends ask him about the property. Nobody asks Marcus about anything. The social validation alone makes Jake feel like he's winning by a wide margin. By year three, Jake has collected roughly $64,800 in rent. His total mortgage payments come to about $47,880, leaving $16,920 in gross cash flow. That sounds encouraging, until you subtract everything else. Property taxes run approximately $3,000 per year. Insurance adds another $1,500. He's already replaced a water heater for $1,200, repaired a leaking roof for $2,800, and absorbed 1 month of vacancy between tenants, $1,800 in lost rent, plus $600 to clean the unit and relist it. Jake manages the property himself to avoid paying a management fee, but that means late-night phone calls, weekend showings, and coordinating contractors on his lunch break. After every real cost, Jake's actual net cash flow across 3 years lands somewhere between $2,000 and $4,000. Not the $16,920 that looks so clean on a napkin, and that figure doesn't account for a single hour of his time. Marcus, by contrast, has contributed $50,000 upfront plus $10,800 in monthly deposits, earning roughly 10% average annual returns. His portfolio sits at approximately $76,000. He has spent 0 hours managing anything, 0 phone calls, 0 emergencies. Jake still has leverage working in his favor, though. His $250,000 property has appreciated 3 to 4% annually and is now worth somewhere between $270,000 and $280,000. His equity, the gap between what the house is worth and what he still owes, has grown to roughly $55,000 to $65,000. That's genuine wealth, and it arrived partly through the bank's money. It's the one advantage stock investors cannot easily replicate. The monthly rent figure is the number everyone discusses, the one on real estate forums, the one a landlord friend brags about at social gatherings. What rarely gets mentioned is everything that exits that rent check before you actually keep any of it. Vacancy. The average rental property sits empty roughly 1 month per year. That isn't a catastrophe, but it is a full mortgage payment with zero income to offset it. When a tenant departs, you're absorbing cleaning costs, minor repairs, listing fees, and your own time screening and showing the unit. Maintenance and repairs. The standard guideline is to budget 1 to 2% of the property's value annually for upkeep. On a $250,000 house, that's $2,500 to $5,000 every year. Some years, it's a $200 faucet repair. Other years, it's a $7,000 HVAC system that failed in August and cannot wait, especially when your tenant is threatening to leave. Capital expenditures. Roofs last 20 to 25 years. Furnaces last 15 to 20. Water heaters last 10 to 12. These are guaranteed future costs that arrive in chunks of $5,000 to $15,000. If you're not setting money aside every month for these, you're not running a business. You're running on luck. Property management. If Jake hires a professional manager, that's 8 to 10% of monthly rent gone immediately, roughly $150 to $180 per month. If he manages it himself, he's working a part-time job without compensation. Either way, it carries a real cost. And then there's the risk nobody wants to discuss: problem tenants. A tenant who stops paying and understands the eviction process can cost 3 to 6 months of lost rent plus legal fees. That single event can erase an entire year of profit or more. None of this appears in the $470 monthly cash flow figure, but it always surfaces eventually. By year 5, Jake is deep inside the reality of being a landlord. He's on his third tenant. He replaced the roof for $8,500, handled a plumbing emergency that cost $1,400, and spent 1 month with the unit vacant between tenants. He's raised rent to $1,950, which helps, but property taxes and insurance have risen as well. His actual cash-on-cash return, the money he keeps relative to the capital he deployed, is hovering around 3 to 5% after real expenses. Not bad, but nowhere near the figures he quoted at social gatherings. Marcus is still doing absolutely nothing. His portfolio has grown from $50,000 to somewhere between $135,000 and $150,000 by year 7, including his $300 monthly contributions. He didn't select individual stocks. He didn't time the market. He simply didn't interfere. The compounding has begun to accelerate. The gains on his gains are now generating more new wealth each year than his original contributions were. By year 10, Jake's property is worth roughly $335,000 to $350,000. His remaining mortgage balance sits at approximately $166,000, putting his equity at around $170,000 to $184,000. Over the decade, after subtracting every real cost, mortgage interest, taxes, insurance, repairs, vacancy, capital expenditures, his total out-of-pocket expenses beyond the original down payment land somewhere between $20,000 and $35,000. Marcus's portfolio, with consistent $300 monthly contributions and roughly 10% average annual returns, sits at approximately $165,000 to $180,000. He contributed $50,000 upfront plus $36,000 in monthly deposits, $86,000 in total. Everything beyond that is pure compound growth, earned without spending a single weekend on repairs. At year 10, they're surprisingly close in total wealth. Jake may be marginally ahead thanks to leverage, but Jake also invested hundreds of hours managing his property, took on hundreds of thousands in debt, and concentrated his entire investment in a single asset in a single location. Marcus spread his capital across thousands of companies and never lost a night of sleep. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is either fully paid or nearly so. His equity sits somewhere between $400,000 and $500,000 depending on appreciation. He has been collecting rent throughout, but after 20 years of maintenance, repairs, tenant turnover, taxes, insurance, and at least one significant renovation, his total net profit from cash flow might be $40,000 to $80,000 above what he spent. Perhaps more in a strong market, perhaps less in a flat one. Marcus's portfolio, at a 10% average annual return with $300 monthly contributions, has grown to approximately $420,000 to $460,000. Total contributions over 20 years came to $122,000. The remaining $300,000 plus is pure compounding. No debt, no tenants, no 2 a.m. phone calls about a burst pipe. When you compare net worth, they've arrived in roughly the same territory, somewhere between $400,000 and $500,000 each. But how they got there is entirely different. Jake worked for his. Marcus waited for his. Jake carried stress, risk concentration, and illiquidity. Marcus endured market volatility, but retained liquidity and freedom. And here's the variable that shifts the math dramatically. If Marcus had increased his monthly contribution by just $200, bringing it to $500 per month, his 20-year portfolio jumps to roughly $550,000 to $600,000. In the stock market, increasing your contribution produces a multiplied effect through compounding. In real estate, increasing your investment typically means acquiring another property, taking on another mortgage, and doubling your operational workload. Presenting only the downsides of real estate would be misleading. Index funds carry genuine risks that tend to get glossed over. Volatility is brutal. In 2008, the market fell roughly 37%. In early 2020, it dropped 34% in a single month. If Marcus had $150,000 in his portfolio and watched it fall to $95,000 within a matter of weeks, that isn't an abstract number on a screen. It's a gut-wrenching experience. And the data is clear. Most ordinary investors panic sell during crashes and buy back in after the recovery, locking in losses at the worst possible moment. There's also no cash flow. Unlike a rental property, index funds don't send you a monthly check you can spend. Dividends exist, but on a total market fund, you're looking at roughly 1.5 to 2% yield. On $150,000, that's approximately $200 per month, not replacing anyone's income. And there's no leverage. Marcus used $50,000 to control $50,000 in assets. Jake used $50,000 to control $250,000 in assets. That 5-to-1 leverage is powerful when property values rise, and it's the primary reason real estate generates more millionaires than the stock market in many surveys. Finally, there's no equivalent to depreciation. Real estate investors can deduct the theoretical decline in a building's value from their taxable income, even when the property is actually appreciating. That's a legal tax advantage stock investors simply don't have access to. Real estate outperforms in specific, identifiable circumstances. If you're in a market where the rent-to-price ratio is strong, meaning monthly rent represents at least 0.8 to 1% of the purchase price, the cash flow math works in your favor from day one. If you're prepared to treat it as a genuine business rather than a passive side project, screening tenants carefully, budgeting for capital expenditures, building systems and processes, the returns can exceed stocks, particularly with leverage. Strategies like house hacking, living in one unit of a multi-unit property and renting the others, can reduce your own housing costs to near zero while building equity simultaneously. That's something the stock market simply cannot replicate. And tax deferral strategies that allow you to roll profits from one property into the next without triggering capital gains Taxes enable portfolio growth in ways stock investors can't access outside of retirement accounts. Real estate isn't a flawed investment, it's a misunderstood one. Jake and Marcus both walked away from their initial decision, believing they'd made the intelligent choice. Jake was convinced real estate was the proven path to wealth. Marcus was convinced the market would do the work for him. Neither one actually sat down and mapped out the full picture, what their choice would cost in dollars, in hours, in stress, and in risk. Over 10 or 20 years, the real trap isn't real estate, and it isn't stocks. The real trap is selecting either one based on a headline, a podcast clip, or something a relative said at a holiday gathering, without ever running the complete numbers for your own specific situation. The next time someone tells you real estate always wins, or the stock market always wins, ask them one question: did you include everything? Because the answer that includes everything is the only answer that matters.